But the point is, the longest it's ever been in history between the last rate hike and the first rate cut is 13 months. That's it. That would be August of this year. So I think it's pretty clear we're going to have some rate cuts. Regardless of what the question for me is going to be, is it a correction and we ease into a bear market, or is there an outright crash? Because those two things are very different and they have different implications for all of our investments, right?
But in a slower market like we're experiencing right now, especially in the last 4 to 6 weeks, premiums have really dropped off to the point where they're as low as I've seen them in the last 4 years. So that's just,
you must have some physical gold, maybe not all of it, but some physical gold outside of your political jurisdiction. And for us North Americans, I don't want to have to worry about my gold in Singapore. It's great having SWP so close. So
welcome to Inside the Vault with SWP. Join Mark Yaxley as we explore the latest news, reports, and some bullion basics for investors old and new. Let's get to it.
Will the Fed hint at a cut, or are we headed for higher for longer rates in 2024? And are gold stocks undervalued versus the price of gold? We'll discuss this and more with analyst and author Jeff Clark of The Gold Advisor on today's episode of Inside the Vault with SWP. Hello, everyone, and welcome back to Inside the Vault with SWP, a weekly show where we dive into the world of precious metals investing with the brightest minds in the space. If you're new to the show, you can find our previous episodes and other educational content on the Strategic Wealth Preservation YouTube channel. While you're there, please do like and subscribe and leave us a comment with your questions about precious metals investing. I'm your host, Jeremy Barlow, excited to be with you again today. As I mentioned, I will be joined today by metals and mining analyst Jeff Clark from The Gold Advisor, who will join us shortly. But let's kick things off with our weekly market update with CEO of SWP, Mark Yaxley. Mark, what do you have for us today?
Hey, Jeremy. Good to see you again. Despite gold and silver facing pressure from a strengthening US dollar, the Dixie is now above 103 again, and a surging US stock market trading near all-time highs. It seems like I say that every other week. Metal investors still have two reasons to remain optimistic. We've got rising geopolitical tensions in the Middle East following the Iranian-backed drone strike that killed 3 U.S. servicemen and injured 25 others over the weekend. President Biden is now faced with a decision to make about strong retaliation, while Tehran preaches diplomacy, at least publicly in the media. So something to really pay attention to. Gold and silver have both rallied on that news. We'll see how long that rally is sustained based on America's next step or reaction. The Fed meeting this week should provide a little bit more clarity on what their plans are for rate cut hikes we expect in 2024. Despite a resilient U.S. economy, inflation has come down to the point where the Fed may be in a position to start cutting interest rates. Recent market survey showed that the market is totally divided on whether or not the first cut is going to happen in March. 50% of participants expect a rate cut in March, whereas 50% expect that rates will be maintained at their current levels. Historically, there's an average of 8 months between the last Fed rate hike and the first rate cut, which would be exactly the last hike was in July. And if we do get a cut in March, that would be exactly 8 months. So we'll see how that plays out. Obviously, very important because expectations are that a rate decrease would be bullish for gold and silver. And it's worth noting that premiums on physical gold and silver products have dropped significantly in the past 4 to 6 weeks, reaching pre-COVID levels. So we haven't seen premiums on physical products this low in about 4 years' time. Lower product premiums create good value for investors who are looking to buy their favorite gold and silver bars and coins. Back to you, Jeremy.
Thank you for that, Mark. And I know you're going to touch on premiums a little bit more in our Bullion Basics segment. Looking forward to that. But let's jump right into things here with our guest. Joining us once again is Jeff Clark, who operates thegoldadvisor.com, which is a fantastic resource to dig deeper into precious metals and in particular, learn more about mining of gold with great resources and commentary, all for free. On top of that, Jeff has recently released a new book, which he will talk about very shortly. Jeff, welcome back to the show.
Great. Thanks for having me, you guys. I'm glad to be here.
Yeah, it's great to have you back. I know you've got a lot that you want to talk about, so let's jump right into things. I wanted to get your thoughts first on just the first month of 2024. Obviously, there's a lot going on geopolitically, macroeconomically. It's been, interesting for precious metals prices. We saw a very hot end to the year with new all-time highs for gold. But since then, we've been a little bit soft. I wanted to get your thoughts on what you make of early 2024 prices for metals and what you think we could see for the rest of the year.
Well, I'll start off by saying, even though I hate giving predictions, this will be the year that gold makes a new all-time high and a sustainable new all-time high. So it keeps peaking above these and making a new all-time high several times here in the past few months, right? But what I'm talking about is a new sustainable all-time high that remains at those levels, 21, 22, 2300. Heck, I could see us going to 2,500 if something blows up. The reason I'm so bullish on gold for the year is because this is the year that we see the big switch, like Mark talked about, switching from raising rates to pausing rates, actually lowering rates. The Fed themselves has said they anticipate lowering rates. We'll see when that actually occurs and how much. But I charted every single easing period from the Fed going back all the way to the 1970s. And there are 11 of them, easing periods being when they're dovish, they're lowering rates or not raising them anymore, leaving them real low. During those 11 dovish periods, the gold price has risen in 9 of them. And the 2 times it didn't rise, it fell by single digits. So based on what history says, I have no choice but to be bullish on gold for 2024.
Yeah, and I kind of wanted to touch on that actually, because 2 months ago when you were on the show last, we were discussing the US dollar. We were talking about interest rates, of course. You pointed out that the average time from the last rate hike to the first rate cut historically had been 5 months. Earlier in January, Fed Reserve Governor Waller mentioned that economic activity in the US was strong, labor markets were in good shape, and inflation was coming down gradually to 2%, and that he saw no reason to move as quickly or cut as rapidly as in the past, which might counter that kind of 5-month average that you mentioned. Do you still, obviously we've got a Fed meeting starting tomorrow, what do you think is going to happen? Are they going to start to, give us the idea that a cut is coming, or do you think they're going to pause and, kind of keep us on the edge of our seats?
Well, the average time, it depends on when you measure it, is usually 5 months. As Mark pointed out, there's some of those periods have been 8 months on average. But the point is, the longest it's ever been in history between the last rate hike and the first rate cut is 13 months. That's it. That would be August of this year. So I think it's pretty clear we're going to have some rate cuts, regardless of what they may do tomorrow. To be honest, I watch the headlines and what they say, but I have more important things to do in my life than sit on the edge of my seat and wait for what the Fed's going to say or do. I hate that we have to rely on them and watch what they do, that impacts our market so much. It shouldn't be that way. I'm kind of with Ron Paul and the Fed, man. Let the market decide what these rates should be. That said, I don't know if they're going to lower rates tomorrow. I doubt that we see that. But my point is that it's coming this year, and that's bullish for gold and the miners too.
Well, okay, I want to pivot actually to a question that I had for a little bit later in the show, but talking about, the rest of the year being bullish for gold, we've also seen an incredibly hot market, stock market, as Mark alluded to just a moment ago. We've seen new all-time highs in the S&P 500. Other indices are up. Christopher Mullen from the Technical Traders was on with us last week, and he said, this is eerily similar to the 2008 bubble where everything was reaching new all-time highs, and then the bottom kind of fell out. Do you think that that kind of coincides with, what's going on this year? Like, do you see, that everything's overbought at this point and that we should expect a correction at some point?
Oh, there'll be a correction. That's pretty, clear. Just because there always are corrections sooner or later, and we are overvalued now. The stock market is overvalued. It's been hot. It's near all-time highs. So, yeah, there's going to be a correction at some point. Um, the question for me is going to be, is it a correction and we ease into a bear market, or is there an outright crash? Because
Right.
those two things are very different and they have different implications for all of our investments, right? But during the 10 biggest stock market crashes in history, again, going back all the way to the 1970s, gold has risen in all of them but three. It fell in one of them, more than the S&P fell, and it fell in two, but less than what the S&P did. And all the others, it rose. So we have some reasonable historical expectations that gold can actually shield us from an outright stock market crash. So recession, same thing. If we go into recession, and who knows if it's going to be mild, or we get some unexpected surprise and like a black swan, and we get a hard landing, or we get a stock market crash and that pushes us into a recession, regardless of what the cause may be, gold usually rises during recessions. So we have a lot of historical evidence that gold can shield us from, these nasty kind of events. But yeah, I wouldn't be surprised in the least to see a stock market correction at some point this year.
Yeah, and I think you made a very good point there at the end that gold shields us from these kind of black swan events. We saw it during COVID most recently. The price of gold took off, while everything else seemed to be plummeting. So, yeah, it's definitely something to keep in mind there. I also wanted to talk, we spoke about the US debt last time that you were on. You mentioned it in our most recent SWP newsletter. Just for, maybe the investors that don't necessarily understand the implications of, this outsized debt that the US is incurring and the amount of borrowing that they're needing to do. What are the real implications of unchecked borrowing for the everyday person?
What's happening right now is the debt is soaring at just unprecedented levels, and it's like we keep saying this every year, though. It's at new all-time highs still. The real issues are first that an oversized debt load limits your options. So you have limited options, whether you're a family that has too much debt or you're a country that has too much debt. You have limited options on how you can maneuver and respond to that. In the case of the US, they can just print money. They can print currency and just create it out of thin air, which of course adds more to the debt, but it cheapens the currency even more. So I think, as Mark referenced earlier, the DXY is ultimately headed lower. Who knows how high it goes first? But it's ultimately headed lower simply because the debt load is just too high and it's really unmanageable. It makes the fallout worse as well. So when you try to deal with it and you reach a tipping point, not only does it limit your options on how to deal with it, but it makes the fallout worse. So it would make some kind of recession into a depression, for example, or a stock market crash into a Great Depression type of crash. So there's some nasty things that can really happen because the debt load is too high. It seems like, we don't have to worry about it because we've never had to worry about it,
Right.
but there are implications to this long term, and it does hint at the possibility that, we're going to have a new monetary system at some point, and that has a whole new set of implications and ramifications, not just for the economy and the markets, but for each of us individually as people and as investors. So none of this is good. It's just another big band-aid on top of everything. So the real thing that's happening right now, not to go on too long, but the other issue is that the deficit is soaring, and the interest we're paying on the debt is over $1 trillion now annually. That's just unfathomable. So, all this is adding up, and at some point it's going to matter and it's going to be nasty. And that really argues for why someone needs to make sure they own a material, significant, meaningful amount of physical gold that's under their control and outside the banking system. And frankly, not to just give you guys a plug, but I'm a true believer that you must have some physical gold, maybe not all of it, but some physical gold outside of your political jurisdiction. And for us North Americans, I don't want to have to worry about my gold in Singapore. It's great having SWP so close. So, as you guys know, I'm a believer in the company and I am a customer as well. So,
I appreciate that. Thank you very much, Jeff. I think it's interesting what you said there about, and you alluded to it last time you were on, that the main reason for an interest rate cut would be the fact that the U.S. owes so much money that like it would behoove them to drop those interest rates. So yeah, it'll be interesting to see what happens tomorrow. All eyes are on the Fed meeting, and yeah, we'll definitely be keeping a close look at that. I wanted to pivot now a little bit more into the metals and mining sector. I actually just watched a talk that you gave at the Metals Investor Forum titled "Yo Mama is So Bearish," which
yeah,
I did quite enjoy. I was actually quite upset that nobody in the crowd or that I could hear yelled back, "How bearish is she?" Because that's how the joke.
right.
I was sitting there yelling it back at the
Right.
screen,
Yeah,
but
I tried to hint at that, but nobody caught on to that little Johnny Carson setup, So I
no,
wish somebody had to.
you had me last night when I was watching it, so don't worry, I caught the joke. I
Good.
wanted to ask you about the mining sector in general because you compared the current price of gold with the price of gold stocks, which are at an all-time low, versus the price of gold. You're incredibly bullish on mining stocks, and I understand you have three main reasons why you're bullish on them for 2024. Maybe you can share that with us.
Well, just briefly, it's all in that talk, like you said, but the first reason is what we've already talked about. The Fed has us set up to be bullish in 2024 on gold and gold stocks, simply because during periods of easing, which typically lasts years, not months, the gold price has risen in most of them. And it's interesting, John Hathaway Sprott pointed out that in the last three easing cycles from the Fed, gold stocks have risen tremendously, not 20, 30, 40%, but double, triple, quadruple in each of the last three easing cycles. So we have historical reason, to be bullish. The second reason is what I have in the book is, gold stocks and gold cycle. And there have been 11 distinct cycles in gold and gold stocks since the 1970s. And gold stocks, every single time they cycle down, they rebound huge, make up anything that was lost, and then much more. So, buying at a cycle low has historically proven to be very profitable for investors. And guess what? We're at a cycle low. And we're not just at any cycle low, we're at one of the worst in history. Sentiment, last year was worse than I've seen, maybe since the 1990s, which was even before I was in the sector. But, that's the time period a lot of investors point to as the worst in mining stock history, as the worst sentiment. And last year was arguably as bad, if not worse. So I think we're at a cycle low, and what comes after a cycle low? An uptrend. So I think we're at that point. So and then the third reason is, stock picking can actually work. My personal portfolio had 6 winners in it last year, despite more stocks being down, mostly because of sentiment, than we're up. And so I actually had a winning year last year in the worst, year for sentiment ever. And I'm not beating my chest. My point is that there will be winners. There will be companies that do well and advance their projects in significant ways, which of course can impact the stock price. So stock picking can work. So, when I add it all up, I'm bullish not just on gold, but on gold stocks, mining stocks, for 2024.
That's awesome. And for anybody that's watching, I highly recommend you search this talk on YouTube, or it's also on pinned on your Twitter account. It's called "Yo Mama is So Bearish" with Jeff Clark, and there was some great charts in there that kind of explained the cycle lows and what happens after when those stocks rebound. Maybe for like the lay person, and I'm adding myself into that group when these gold stocks, when they start to increase, I'm presuming that's based on increased production. What does that do to the gold price? Because I mean, it is a supply and demand metric there. Do they work in tandem, or is it an inverse relationship?
Supply for gold doesn't really change all that much. It goes up about 1.5% a year, maybe 2%, on big years. So gold isn't really about a supply demand factor as much as it is investment demand. Gold is money, full stop. Gold is money. It's the only true money proven by history. That's why we all own it. So when monetary concerns come to the forefront, that's when demand for the metal goes up and, of course, pushes the price higher. The interesting thing about gold demand is that it can come from almost any factor, geopolitics, market issues, economics, monetary concerns, black swans. It's a fear metal. So when, uncertainty rises, gold is going to rise. That's going to push demand up, and it's going to go. So that's the way to look at it. It's the best monetary insurance policy that you can have.
That's literally the perfect answer. Thank you for that. I wanted to talk about the other metals really quickly. Let's start with silver. In the most recent SWP newsletter, again, Commerzbank is forecasting silver to hit $30 in 2024 on the back of increased interest in green technology. Silver investors have obviously been hearing this for a long time. That silver is going to pop. And they're all kind of just sitting and waiting. And I have to ask you, Jeff, what the hell is going on with silver?
Yeah, it's been very frustrating. I'm a silver investor too, both in the metal and in miners. It's been very frustrating. The sentiment there has been even worse than it has for gold. The thing to be aware of is throughout history, it has long periods where it's very boring, and then all of a sudden it'll spike. I have a talk online, boring, boring, boom. That's what silver does. That's its DNA. It's been boring. We had the COVID crash in 2020, then we had the COVID bounce. And during that bounce, gold soared 40%, but silver soared 140%. So it's still showing that it has leverage, but it's been, we're coming up on 3.5 years since it's done anything. So its time is going to come. What I think is going to be the trigger, frankly, is making that new all-time high in gold that I referenced earlier, that sustainable, believable new all-time high in gold. Once gold starts to run and investors, including in the mainstream, Wall Street, even in our community, believe that it's not going back, it's not going to fall back to 2000. It's up there to stay for good. Once that happens, I think the fuse is then lit for silver. It historically trails gold. Gold will make a move and silver will do nothing. It'll still sit there. And then 6 months later, give or take, all of a sudden it ignites. So if we get, a new all-time high in gold sometime this summer, or the next few weeks, whenever it occurs, I think you can then light the fuse on silver and look for it to make its next spike. And spike it does. It'll spike tremendously. I'm not talking about 10, 20%, but more, like what it did back in COVID. That was a 140% rise. That's its average spike, by the way. That's how much it runs in a relatively short period of time. So that's the kind of spike I would expect to see. It'll come. Just like, again, looking back at history, these spikes occur on a regular pattern and it'll come even though it's been very frustrating the past few years.
Yeah, and I mean, we even saw it again in late November when gold hit that new all-time high of 2180. I mean, silver was up around $26 and people were going, "Oh, is this the big silver push?" And No, that's just gold moving or silver moving with gold, you know, just keeping pace with it. You know, at a
Yep.
certain point, like you said, it's going to have that kind of, you know, pop, and hopefully we start to see what silver investors have been waiting so long for. Lastly, want to touch on platinum and palladium, which is something that we don't discuss much on this show. I wanted to get your thoughts on the platinum group metals. Nornickel, which is the world's #1 producer of palladium, said that output of the metal may fall almost 15% from 2023 levels due to geopolitical risk, but that an increase in production in the fourth quarter is expected to translate into platinum group metals production in the first quarter of 2024. So my question for you is, you know, are platinum and palladium, where do they sit in an investment portfolio? Are they worth owning? You know, are there any like mining companies that you're looking at for the platinum group metals? What are your thoughts?
Well, platinum and palladium did not do well in 2023. Both were down, especially palladium. They were down double digits. So they did not have a good year. But the thing with platinum and palladium is, first of all, they do respond to supply and demand factors much more than gold does, and even
Right.
silver does. So that's something to pay attention to. If you're going to see a supply demand squeeze in either one or both of those metals, that might be a good opportunity to pick some up. Investment demand in those two metals, though, is relatively low. As I'm sure the audience knows, 90% or more of demand for platinum and palladium are industrial and primarily for auto catalysts. So it really depends on economic health and those supply demand factors. That's when you want to look to go long maybe on those metals. I personally don't own them right at this point, but that's not advice, and I'm not necessarily an expert that follows those real closely. But I think, when that setup gets to a point where there's going to be a spike in demand, there's going to be a big drop in supply, that's when you want to take a closer look at those metals.
Awesome. Thank you. Before we let you go, want to talk about your book that's coming out. Obviously, it's up behind you there. Pay Dirt, Mining for
Yeah.
Profits with Gold and Silver Stocks. Tell us, a little bit about what's in the book, what we can expect from it, and also, most importantly, where we can find it as well.
So it's actually been out for a while, but it just came out in paperback, in physical form for the first time. So you can get it on Amazon. We have links to it on our site at thegoldadvisor.com/book, or you'll see the tab there. So you can get a digital download online, which is the cheapest form, or you can get it on a Kindle, some kind of reader, or you can get it in physical form. So I'll be at some conferences in both March and May, and so what I've been doing is taking some physical copies with me and selling them a little cheaper if someone pays cash. So there's multiple ways to get it. I'm glad I wrote it. It was a lot of work. It took 2.5 years off and on, but I'm glad I did it. And it's not just me that's in the book, but there are 16 other experts from the industry invited to participate. So you have their input as well, which is very specific, by the way. They were very specific on what they said one should look for. But it's basically very simply a how-to book on how to pick mining stocks on your own. And I promise if you follow it, you'll be 90% ahead of the herd there. So.
Well, like you said, you were a winner in 2023 despite a down market. So that's proof in and of itself. Jeff, I want to thank you once again for joining us. We'll definitely have you back on in the near term. And again, for those of you that are watching, Jeff's book, Pay Dirt, Mining for Profits with Gold and Silver Stocks, available on Amazon, but also available in paperback if you like to have the physical copy. Also, head over to thegoldadvisor.com to learn more about mining and precious metals. Thank you very much, Jeff, for joining us once again.
This was great, you guys. Thanks for having me on. We'll do it again.
We certainly will. As always, my friends, we like to conclude the show with Mark's weekly Bullion Basics segment where he gives us a little nugget of knowledge. So, Mark, take us to school. What do you have for us today?
Yeah, thanks, Jeremy, and thanks, Jeff, for being on the show today. A lot of really good information as usual. I touched on product premiums on physical gold and silver bars and coins being at a 4-year low in the market update this week. So I wanted to expand on that a little bit because it's significant and it's something that investors can certainly take advantage of. So I just want to do a little bit of a deep dive on premiums today. So first of all, if you're a first-time buyer of gold and silver, it's important that you understand what it means. And I know if you're out there and you've been buying gold and silver for a while, this is just a quick review, but basically it's the total product price. So if you see the total price on a website that you're going to be buying from minus the spot price, that's the premium. That's what we call the premium on the physical product. So I'll give you a quick example. If you see a silver eagle coin listed at $28 and the spot price is $23, then the premium for that silver eagle coin is $5. One of the FAQs, the frequently asked questions we get a lot from our clients actually is, do premiums fluctuate based on market conditions? And the answer to that question is yes, they do. Depending on the supply and the demand of specific physical products, the premium for that product will in fact fluctuate over time. So in a hot market like we've seen over the past 4 years, where there was a relatively consistent and high demand for physical bullion, premiums were really, really high. I remember doing a podcast about a year ago when I was saying that the premium on silver eagles was running at like $12 or $14 over the spot price. It was just incredible and insane at the same time. And in a slower market like we're experiencing right now, especially in the last 4 to 6 weeks, premiums have really dropped off to the point where they're as low as I've seen them in the last 4 years. So that's just a reflection of the supply and demand as it works its way through the supply chain from the producers all the way down to retail investors. So, people have the tendency to kind of forget about the premium when they're watching the spot price. People tend to get really fixated on the spot price and how that's performing. But the premium, if it comes down by 5% on a silver product, that's the same thing as the spot price coming down 5%. So, you can really take advantage of that in a market like this, and coupled with relatively soft spot prices. Jeff alluded to it, silver at $23 an ounce, that's half of the all-time high, or below half of the all-time high for silver. Coupled with low premiums, you're getting really, really good value when you make a purchase where you have a relatively soft market and low premium. So a little bit of information there. And one last tip, Jeremy, when you're speaking to your favorite precious metals dealer, whether it be us at SWP or another dealer, always ask them if they've got any odds or ends that they're looking to move. Because particularly in a market like this where the phone isn't ringing that much, there's going to be something in the vault that the dealer is looking to push out the door. And if you happen to be the guy or the gal that asks them what the best deal is right now, chances are you're going to save a few extra dollars above and beyond what we've already talked about.
That's awesome. Thank you very, very much, Mark. And that's, I think, my favorite Bullion Basics segment that you've done. I think those are the kind of tips and tricks that, the new investors in the metals market might not know. And I think that's very, very insightful and can definitely help them get a leg up on, what might be their first purchase. So that's everything for us today. Thank you so much again for watching. Thank you to Jeff Clark of the Gold Advisor for joining us. Make sure to check out his new book, Pay Dirt: Mining for Profits with Gold and Silver Stocks, again, available on Amazon and in paperback form. And if you would like to know any more information about the precious metals space, head on over to the Strategic Wealth Preservation YouTube channel for all the information you need to know on precious metal investing, or email us at info@swpcayman.com, and a member of our team will happily assist you. Until next week, stay safe and happy investing.
Thank you for listening to Inside the Vault, the podcast that opens the door to precious metals. We hope you learned something new and enjoyed the show. See you next time on Inside the Vault with SWP.